Give me a moment while we finish our setup here. And then here as well. Well, good evening, everyone. This is Sheila once again from Just Local Homes here at Keller Williams. Tonight, our special guest is Ken Stray from Scorewell Credit. Our topic for today is actually how to boost your credit score towards a home purchase. Nonetheless, um, we have Ken Stray here, who is the preeminent expert for actually fixing your credit and anything to do with credit scores. So, without further ado, let's hear from Ken Stray. And our first question for today is Ken, can you give us an idea of how credit score generally works?
Good. Well, thanks again for the opportunity. I love it. And, I love educating people on credit. And, credit threads its way through everything in life. And generally, like I was mentioning to you offline, people come to me after they found out something on their credit. But to be concise, you want to have a credit score between 740 down to 640 in that range. The higher the better for lending opportunities, but anything below 640 is going to be a risk for a lender, and maybe they can't underwrite the loan. But for general purposes, having scores that are in the high 700s is going to suit you for, purchasing a car, renting an apartment, or anything of that nature has to do with money.
Okay. What are the components that make up a person's credit score? Because for most people,
Yeah.
it's almost like a mystery.
Yeah, so basically the credit score is a foundation of your open and past credit. So to make it simple, I always suggest to people that they have at least 1 to 3 credit cards. Now I know that's kind of scary, but a credit card is very powerful on a credit report. And ideally, you want to keep a credit card for many, many years. The longer you have it, the better. You want to keep the balances as low as you can. But basically, having 1 to 3, and then as you add a car vehicle or a student loan or a mortgage, for a total of about 5 different things on your report. And that builds the foundation.
So my question, I have a common situation actually when I have clients who are buying a home, and we often find that the credit scores between the wife and the husband are wildly different. So, for example, the wife would probably have all the credit cards for shopping and groceries and gas, and the
Mm.
husband would almost have no credit because he only uses it for gas for his car to go to work.
Right.
Would How would you suggest that imbalance be fixed? Because when getting a loan for a home purchase, both credit scores would be important.
Right. So, it's always important to have something open on your credit. So, in your scenario with the husband having minimal credit, hopefully he would have at least one open trade line, and then in a couple, or even a parent and a son, or a parent and a daughter, the one with the stronger credit can always add the other on as an authorized user, which
Okay.
transfers over history, transfers over, seasoned, aged history, which is good. And as long as the credit card that they're adding them on is not, doesn't have any late payments, and ideally the usage on it is fairly low.
Mhm.
That makes sense?
Yeah, it does make sense. So, adding on the person to the credit card is a better solution than opening a new credit card.
Well, yes. Short term it is because opening up a new credit card for this other person is going to generate an inquiry, and that's actually going to lower the score. So,
Mhm.
yeah, when we meet with clients, we strategically give our answers to benefit their goals. So, if they're looking to purchase, what are the things that they can do to facilitate that? And then what are the things they don't want to do, which would lower the credit score?
Okay. So my other question is, our team actually has a lot of senior clients, and one thing that we see now with a lot of online phishing and scam is now we end up with having to address credit scores that are not as favorable to a home loan. What
Right.
would you suggest for a person to do once they realize that something is not quite right?
Right. Well, I'm a senior as well, so I relate to them. But the first step, if there's, if we identify that there's identity theft, if there actually is identity theft, the very first thing to do is to file a police report. We can help facilitate that. But sometimes, maybe it's a family member that has. um abuse their credit. And I mean, we'll just talk about what the options are. I mean, if I tell a couple they're going to have to file a police report on their son, they're going to say no. But we can look at the damage, how it is, how impactful it is, and come up with a workable solution. So, you know, it all depends too on the age of the damage. So, any damage that is less than 4 years old is probably more concerning, especially if it's under 2 years old. But again, once we see it on the credit report and we get any backstory to it, we can resolve it.
Okay. And can you tell us how long will it usually take to resolve maybe it is?
So So, in working with the credit bureaus, there's a law that states that we have a legal right to updated, accurate, and verifiable information. So, what we do is we go into the credit bureaus electronically and ask them to validate layers of information. So, the law states that the credit bureaus and the creditors have 30 working days, which we kind of spell out to be 45 calendar days. So that's how long it takes for a dispute to be, worked on. When we work on credit damage, generally I work with a client for 6 months because it's kind of like peeling away layers of an onion. We ideally like to get things off quickly, but sometimes we have to go back in there and file a dispute if we haven't fixed the problem.
Okay. Is there a cost to fixing one's credit?
Yeah, so for me, number one, 100% no pressure, no cost consultation. Once again, I do have to have a credit report so I can answer questions concisely. If the clients are working with a lender and they have a credit report, I can use that. If not, I have a source where we can get a credit report. Um, but again, when we are meeting, we are looking at the issues. I will give them a plan of things that they can do, do this, do this, do this. And then if there is damage, I will detail out what we can do. And to be specific on cost, our fees range from a start of 300, and the very max they would go up to would be 1,200 if that's like a couple. and the damage is severe, and we can split that payment up over 6 months to make it more affordable. But again, I'd say that 70% of our clients right now are falling in about a $600 range, and we actually split it up in six monthly payments of 100 a month. So
All right. So there
cost
you
is usually not a factor.
All right. So another common situation that I see this time for younger buyers is that they're getting ready, aiming for a home purchase, only to realize that their credit score is less than stellar. And so they start paying off debts and
Yeah.
only to find out that their credit score actually went south. Could you give us an idea of what are the good
Yeah.
things to pay off and maybe things to
Good.
keep in your portfolio?
Good. Yeah. I don't get asked that question very much, and it is a very good question because, for example, there's two different types of things on your report. There is revolving accounts, which are like credit cards and store cards. And then there's installment accounts, like a mortgage is kind of considered installment, a car loan, student loans. Sometimes you're buying equipment or something; those are installment. Now, paying off credit card balances is always a good thing. Paying off a credit card is nothing but positive. It's not important to really pay down an installment because if you have a car loan and say you owe $10,000 on it and you pay five, you would think that you're reducing it by 50%, and that's awesome. Well, in the scoring model for an installment loan, they don't really factor in the balance. They only factor in whether you're making the required payments. So revolving credit cards, those are the ones you want to pay down.
Okay. And so, what if we have a client who paid down her car loan, for example? How long of a history does she have to generate to get back to the original score, or maybe
Well,
end up with a
okay,
higher?
so that's a little bit more complicated, and the reason for that is that if you have 1 to 3 credit cards, your score can only go so high. Now, when you add in a car, an auto loan to that, you're taking on a different type of risk. And if you're doing well on that, the credit formula rewards you. It doesn't penalize you if you don't have it, but it rewards you if you do. So, like I say, in a perfect credit profile, having 1 to 3 credit cards, not that you have to buy a car, but a car is good for credit. Not that you have to buy a house, but a house is good for credit. So having these things is positive. Now, if you pay off a car, then after 6 months, the credit formula will not acknowledge it, and you might see a score decrease.
All right.
So it's a fine art of balance, and we can help the client understand that.
Okay. So if a person also has another scenario, if a person has, for example, medical bills that all of a sudden they stop paying, or I don't know, other things similar to that, would that, or rent that they didn't pay, what
Mhm.
would be the expected impact on their credit score?
To have those things, okay. So let's just say someone had a 720 credit score and they got a 30-day late. They would get about an 80 to 100 point score loss. So
Wow.
a late payment is the most serious thing that you want to avoid. When it comes to collections, you mentioned medical. That was a big, it's always been a big issue, but as of the past 2 years, they have really modified that, which means that if a medical collection is under $500, it cannot go on the credit report. And then the second caveat to that is that if, in the past you didn't pay your dentist and the next month they put it on your credit. Well, now they have to wait a full year before they can do that.
Okay.
But any other collection, like if you didn't pay your rent, that kind of goes in, that usually won't go into your personal credit report unless they send it to a collection agency. But it does go in what's called your rental acquisition records, which is part of the credit bureaus.
Okay. All right. Now, for those preparing for purchase, um, what would be your best advice to give?
Well, my best advice is always know what your credit is. Make sure you understand it. Now, a lot of us get scores from somewhere, and that's a whole different discussion on what type of scores and which ones are accurate or which ones are not. So let's just say your bank tells you your credit score is 780. Well, you can pretty well feel comfortable that you're doing pretty good. But if your bank tells you you have a 610 or a 580, you can say, I probably have some damage on my report. So when you're looking to do lending or a vehicle purchase, you want to know where you stand. I firmly believe in a good monitoring program. Again, I'm not trying to sell anybody anything, but I do have a program that I recommend, and people can reach out to me and I can tell them. And again, anytime someone talks with us, we talk with them. It's not just, here's a link. And there's no personalization.
All
So
right. Yes. And we do appreciate that. And so before we go, Ken, why don't you give them your contact details so that they can
very
reach out to you if they need help?
good. Thank you. So the best way is email, and my email is my name, Ken Stray. You can see it there, KENSTREY at scorewellinc.com. That's SCOREWELLINC.com. And my website is scorewellinc.com.
All
Or
right.
you can Google me, Ken Stray, and I usually will come up.
All right. Well, thank you so much, Ken. I appreciate
Pleasure.
you taking your time to help our audience. And till the next time, we'll see you again.
Okay. Have me
Okay.
back. Bye
Bye
bye.
bye.